Welcome to this video day, which is for beginners, and what we're going to be doing today is learning how to build a strategy with rules that can lead you to trading success, and also operating your trading strategy with the art of flexible focus. So what that is will become clearer as we go through the video, but it's something that all great traders have. Okay, now in relation to developing your trading strategy, what I want to do is give you two trader syndromes. They're actually psychological disorders. Okay, they're the exact opposite of each other, yet 90% of traders who lose money will exhibit the majority or all of the characteristics of one of these disorders. Now, why I'm showing these, I'm just going to summarize them on a short storyboard, is in terms of achieving Forex trading success, your trading strategy has to go through the middle of these disorders. Let me just show them to you, and then we'll discuss in a little bit more detail. It will become a lot clearer. Back after that short summary there. Now, in terms of trader syndrome A, how many traders actually come in the markets wanting to make as much money as possible quickly, or they want to have, the thrill of trading, the excitement, the adrenaline rush, or they might even want to have both. It's a huge amount, and these traders just do not think that it's a professional business. They'll do is they'll follow tips and advice from so-called professionals on sites, let's say like dailyfx.com, which is hugely popular, or they'll trade a news story off Bloomberg or Reuters. They end up trading with the consensus. They'll end up losing. Also in this group are the huge amount of day traders or scalpers who come in the markets. And as soon as you look at price action, short-term timeframes, your emotions will come into play. Also, what will happen is you'll see price action moving quickly or strongly in short-term timeframes. It isn't really relevant in terms of the big levels that matter most of the time, but it looks like it is. And traders are just then act impulsively to trade that short-term price action. It's noise. They end up losing. Also in this group are the traders who have heard the rule, cut your losses, for example, run your profits. They'll put a stop loss in on their trade, for example, and then as soon as price moves towards it, they'll move it back, keep moving it back. I've seen that so often. And when they eventually take a big loss, you ask them why they did it. They said, I thought it'd be different this time. It's the most expensive phrase in Forex trading. So you can see, how people lose if they have that syndrome. In terms of trader syndrome B, the exact opposite. Okay, these traders are way, way too analytical and too rule-based. And if you're a perfect example of this, just go and look at the huge amount of videos on YouTube where traders do complicated analysis and take a lot of time over it. I watched a guy the other day on YouTube. It took him 15 minutes to explain a trade setup. It was all very complicated. And it does appeal to people, actually, in terms of work ethic. The more work you put into something, the more likely you are to be rewarded. If you think hard and consider things carefully, that's good as well. And of course, if you make it a little bit complicated, then that's got to be better than keeping it simple, hasn't it? But of course, that's not true. What you need to do is, you can have rules, but you must not make your strategy too complicated. And a lot of people, I think, like all this complex analysis, you've seen it probably, like Gartley patterns, Elliott wave, advanced Fibonacci, because they can delegate the decision-making process more away from them to the strategy. That is why a lot of fixed strategies appeal as well. Trader doesn't have to have responsibility. In this group also are the people who do suffer from paralysis. They cannot take trades because they don't really have the confidence. They spend all the time on analysis, but they're not risk takers. They don't enjoy taking risks, so they don't act. So in terms of what we need to do, we need to get those rules in place, to keep our emotions out of our trading, and also develop the art of flexibility as well, flexible focus in relation to our strategies. Now, there are many different ways of doing this. You actually have to do it if you want to make money from the markets. I'm just going to show you the rules that I have in place in my trading strategy, and also where I allow myself flexibility as well. So I'm just going to do a quick summary, and then we'll be back to sum up. Okay, here we're going to look at the rules that I use in terms of technical trading and the flexibility that I allow myself. Now, in terms of this framework, it's obviously just my personal view, but I think it's a good framework for anyone to consider. Now, in terms of rules, I'm going to start with money management. Firm believer in that old Scottish saying, if you mind the pennies, the pounds will look after themselves. You've got to preserve your equity. If you do, of course, your edge will work longer term and you'll make money. Now, in terms of rule number 1, stop placed at entry of trading signal. So I immediately know my get out point. A lot of beginners use mental stops. As soon as it runs through the mental stop, they won't adhere to it. So particularly for beginners, stop should be in as soon as you put your trading signal in. That means, you've got your get out point. Okay. Now, point number 2, maximum risk exposure of 10% on all open trades. So if everything goes wrong, the maximum I can lose is 10%. Many traders don't ever look at this, which is ridiculous. You've got to keep drawdowns manageable. I think, if everything goes wrong, 10% is fine. Okay. Point number 3, if 10% is achieved, that's in profits on all open positions, all trades are liquidated. When you've got a decent open profit in the market, very often, me included, traders get complacent or they want to gear up even more and then give all the money back to the market. If I get 10%, I'm happy. I'll come out, go flat, then I'll come back in the market, probably have a day's break, come back in with a clear head, or much clearer than when I'm sitting on that open profit. So I really like that rule. Now, in terms of flexibility, stop level can be changed. And when I say it can be changed, it can only be moved up, or if I'm uncomfortable with the trade, in my I've got a gut feeling, even if it looks all right, I'm sure many traders have had this, it might look all right on the chart, but you just feel there's something wrong. If I get that gut feeling, I could just liquidate at market, so I'll just stop myself out straight away. A small profit or a small loss doesn't matter. Point number 2, I've actually said that. Sorry, I didn't realise I'd written it down as point 2. Right, moving to trade entries. All trading signals through specific price levels. I don't do market orders. Why? Because that brings out impulsiveness. So I will pick a level and I'll place the trading signal, see if it's triggered. I don't not want to act impulsively. Just a price action. If I see it moving quickly or whatever, always come in through some sort of price level. Right, point number 2. Support and resistance levels looked at, or which come through, must be daily or higher time frames only. Okay, never look at hourly charts, minute charts. Yeah, most of the smaller time frames tend to be noise. I like to always use daily or higher time frames. Point number 3, target hit, trade is liquidated. Yeah, if I get to my target, I'm out. I've normally got a profit take in. A lot of traders want to carry on, milk more out of the trade. I normally find when my target is hit, that is the time to liquidate. I've got what I wanted. Number 4, rules for trade entry, only 3 inputs. Okay, and so the analysis itself relies on 3 inputs only. A lot of traders think, yeah, the more inputs they put in, the more successful they're going to be. I'm a firm believer, yeah, a simple set of rules, 3 only. Now, in terms of flexibility, the weighting of inputs varies. Sometimes support and resistance is very important. It's always important, but it can be the critical input. Sometimes volatility can be the major input. Momentum as well I use. And this is really where, over time, you develop a feel for the markets, learning to basically weight inputs in terms of your trading strategy. There's no one set way that is going to work all the time. Okay, so basically that is really the thing you learn over time. Okay, your rules are obviously going to keep you on course, or keep me on course. Then it's your rules in terms of your trade entry, and also your instinctive feel for the market. Also, one other point I would make is that whenever I do a trading signal, I will never do one that is, well, if it goes up through one level I'm going to buy it, or down through another level I'm going to sell it. Why don't I do that? Because I think, in terms of for me personally, unless I've got a strong conviction about a trade either way, I won't do it. I can't do a trade both ways. It just means you haven't got a strong conviction. Now, the list here, very personal to me, but just gives you an idea of how you can have rules, and then a little bit of flexibility in there as well. You need both. You need those rules, particularly money management, to keep you on course, but in terms of your trading strategy, it has to be flexible in terms of the way you do your trading signals. So that's just a brief overview. Now let's just quickly sum up. Welcome back after that short summary. Now, in terms of my rules, they will keep me very disciplined and basically keep my emotions out of my trading, and they'll also help me operate in what is an open-ended environment. If you think about it, many games, so to speak, have an end. Forex trading doesn't. Once you put a Forex trade in the market, it's up to you to end it, either with a loss or with a profit. And I think that in terms of, obviously money management, keeping your losses small, that's pretty obvious that you've got to do that. But in terms of actually banking out profits, you've got to know when to bank them out. I think a lot of traders give back too much open profit. My rules will help prevent me from doing that. Now, in terms of trading strategy, analysis, make it simple, make it quick. I said I've got 3 inputs there. I do, and that's all I'm going to use, and I will weight them differently. Because the market is ever changing. It's all chart formations are subtly different. So you have to develop that flexibility in relation to your trading signals. And I think too many traders look for one set way of trading the markets with very rigid rules. It just doesn't work. And yeah, putting too many inputs into a trading strategy is basically a recipe for disaster in my view. It just doesn't work. Simple is best. So that is the video for today. I hope you enjoyed it. If you ever got any questions or queries, please feel free to email me. Thanks for watching me.